The rule of 72 inches is a cute little lie people tell themselves so they don't have to think. You've heard it. Divide 72 by your annual return. And that's how many years it takes your money to double. 10% return. 7 odd years to double. 7%? About 10 years. Easy. Clean. Comforting. It's also dangerously misleading for anyone over 50 who actually cares about not dying broke. The shortcuts that comfort a 25-year-old are the same shortcuts that quietly destroy a 60-year-old. Charlie Munger never needed the rule of 72. He understood the underlying idea, of course. But he also understood something most investors never bother to absorb. Simple formulas, blindly applied, get you killed when the conditions change. And the conditions have changed. Interest rates, inflation, life expectancy, expected returns, sequence risk. Everything around you is different from the textbook world where that little rule was born. If you're over 50 and still thinking in terms of, I'll double every X years, you're living in the wrong century. Let's be clear. The rule of 72 itself isn't wrong as a piece of math. It's a decent back-of-the-envelope approximation for how exponential growth works. The problem is how people mentally use it. They don't treat it as a rough guide. They treat it as a promise. They hear 7% doubles in 10 years and translate that into my retirement will be fine. They hear 10% doubles in 7 and mentally run the tape forward. 50 to 57, 57 to 64, 64 to 71, and see 3 or 4 tidy doublings like clockwork. That vision feels so good they never ask whether any of the assumptions behind it actually hold in their real life. Munger would call that a lollapalooza of stupidity. Multiple mental errors all pushing in the same direction. Overconfidence about returns. Ignoring inflation. Ignoring taxes and fees. Ignoring the possibility that markets don't hand you steady, smooth compounding. Ignoring the fact that after 50, you don't have many cycles left and you can't afford to blow one. It's not that the rule of 72 is some wicked conspiracy. It's that people use it to avoid thinking about the one variable that really matters after 50. Survival. Start with what the rule actually says. At its core, if you're an R% per year, your money doubles in roughly 72 R years. So at 8%, you double in about 9 years. At 6%, about 12. At 3%, about 24. The arithmetic is fine. If you genuinely earn 8% every year for 9 years, ignoring all friction, you really will double. The operative word there is if. That if is doing a lot more work than people admit, especially in 2026, especially if you're not 25 anymore. Look at how the fantasy plays out in the head of a 50-year-old. He thinks, if I can get 10% a year, my money doubles roughly every 7 years. From 50 to 57, one double. 57 to 64, 2. 64 to 71, 3. I can turn $250,000 into $2 million if I just let it ride. It's a nice story. It ignores reality in about 5 separate ways. First illusion, time. The rule of 72 doesn't care whether you're 25 or 55. Human bodies do. When you're 25 and your money doubles in 7 years, you're 32. You still have a dozen more potential doublings left in a lifetime if you keep saving and don't blow yourself up. When you're 55, a 7-year double lands you at 62. That's Social Security lane. That's heart attack lane. You might get 1 double, maybe 2, if you're lucky and disciplined. You do not get an infinite sequence of clean 7-year jumps. Every assumption error you make after 50 is compressing into those last 1 or 2 windows. Run a realistic case. You're 52 with $300,000 in invested assets. You're thinking rule of 72 terms. At 7% per year, your money doubles in about 10 years to $600,000 at 62. Double again by 72 and you're at $1.2 million. Sounds impressive, but notice how few rolls of the dice you've got. If those 10 years from 52 to 62 are poor in market terms, or you panic and sell at the wrong time, or you start raiding the capital, your tidy doubling schedule shatters. The rule assumed 10 obedient years. You may get the kind that empties your stomach and tests your nerve. Mungers lived long enough to see plenty of decades like that. He didn't walk around saying, don't worry, the rule of 72 will save you. Second illusion, return level. The rule is only as good as the rate you feed into it. Plug in 10, 12%, because that's what some book or salesman told you stocks always return. And the world looks easy. 10% doubles money in roughly 7 years. 12% gets you there in 6. People hear that and start counting their future millions with a straight face. What they're doing is taking a long-term historical equity return, often before inflation, before fees, before behavior, and applying it as if it's guaranteed, tax-free, fee-free, and path-free. That's nonsense. Munger's style is the opposite. He doesn't start from best cases. He starts from what can go wrong. Returns are lumpy. Valuations matter. Interest rate environments matter. If you're 55 today staring at your portfolio, you are not living in 1982 when stocks and bonds both had high prospective returns. You're living after a decade plus of financial repression and asset inflation. That doesn't guarantee low future returns, but it makes it insane to just paste 10% into your head as if the last 40 years will obligingly repeat on command. Be conservative. Suppose your realistic all-in nominal return from a sensible mix of stocks and safer assets is more like 5, 7%. After inflation of 2, 3%, you're looking at 2. 5% real. Now feed that into your beloved rule of 72. At 5% nominal, your double takes about 14, 15 years. At 4%, it's 18. At 3%, 24. If you're 50, 15 years takes you to 65, one double. 18 years takes you to 68, one double. Are you seeing the problem? The entire myth of I'll double several times between 50 and death rests on fantasy returns, or on the idea that your money will sit untouched for 3 decades while you magically fund your life from somewhere else. And remember, that's before friction. You don't live in a world without taxes and fees. A 7% gross equity return minus 1% in total friction. Fund expenses, advisory fees, slippage, some trading becomes 6%. Run 72.6 and your doubling time just lengthened from about 10 years to 12. Add in taxes from tinkering with the portfolio or a tilt toward bonds that yield less, and you may be effectively compounding at 4. 5% net. Suddenly your $1 million dream from $300,000 looks more like $600,000, $800,000 in the time you have, not $2 million. The arithmetic isn't cheating you. You are. Third illusion, path. The rule of 72 bakes in a steady rate. The real world doesn't. It's like looking at the average temperature in a place and packing the same outfit for every day. 30-year average return might be 7. 8%. Nobody lives the average. You live the sequence. The order in which good and bad years show up matters enormously, especially if you start withdrawing after 60. The rule of 72 doesn't distinguish between 7% every year and plus 20%, plus 20%, 20%, 20%, plus 10%, and so on. It treats them as identical. Your account and your life don't. If you suffer a 40% drawdown at 62 and need to pull money out to live, your effective compounding is permanently crippled. You aren't just waiting for a recovery. You're selling into the hole. That means you need much higher later returns just to claw back to where the rule of 72 blithely assumed you'd be anyway. It's one thing for a 30-year-old to say, I'll wait it out. It's another for a 68-year-old drawing 4% a year from the shrunken pile to say the same thing. The fourth illusion is the ugliest, behavior. The rule assumes you're a robot, no emotions, no envy, no panic, no greed. You pick a rate, you earn it, you let it ride. In real life, human stupidity is the constant. People don't earn 7% a year. They earn 15% one year, lose 30% another, then bail out at the bottom. They chase hot sectors in their 50S because they're behind. They rotate into safe stuff at exactly the wrong time. They start taking distributions too early or too big because they can't stand working anymore. In other words, their actual personal return is far below what the market delivered. Munger's entire philosophy is about admitting that you are not better than the average fool. You are the average fool unless you can prove otherwise, and the burden of proof is on you. After 50, that humility is not a nice character trait. It's a survival tool. You don't get to assume you'll calmly sit through every crash the way a textbook investor does. You have to design a portfolio and a plan that recognizes your own likely panic points and keeps you from pressing the self-destruct button at precisely the wrong moment. Put all 4 illusions together: time, return, path, behavior. And the cozy little my money will double every X years story falls apart for anyone in the back half of life. That's what I mean when I say the rule of 72 is broken for you. Not because the math of 72 are changed, but because the environment and your position in life make the naive use of that rule an invitation to overconfidence. So what would Munger tell an investor after 50 staring at a spreadsheet full of doubling fantasies? He wouldn't say, give up. He'd say, stop lying to yourself. He'd tell you compounding is still your friend, but it's no longer your savior. You don't have 40 or 50 years for small mistakes to average out. You have maybe 10 or 20. That shifts the entire objective. Before 50, the game is how do I get this pile growing as fast as I reasonably can? After 50, the game is how do I keep this pile from getting cut in half at the exact moment I need it most? That means the focus moves from chasing return to controlling risk. It means the primary question is no longer what rate can I get, but what level of stupidity can I eliminate? You still care about growth, but you care more about not stepping on landmines, leverage, overconcentration outside your circle, unrealistic withdrawal rates, and lifestyle trajectories that demand your portfolio perform like a circus animal into your ADS. Look at the rule of 72 through Munger's lens of inversion. Instead of asking how many times can I double from here, ask what actions practically guarantee I won't even get one safe double at this age. That list is much shorter and much more actionable. Use debt, pay high fees, trade frequently, overestimate returns, ignore inflation, fail to control spending, insist on retiring at a fixed age regardless of whether the math supports it, believe in shortcuts. If you avoid that cluster of behavior, your modest, realistic compounding has a fighting chance to do something useful between 50 and 75. If you indulge them, no rule of 72 will save you. And here's the part almost nobody wants to accept. At 50 or 60, the most important variable you control is not the rate of return on your capital. It's the rate at which you add to it or drain it. People obsess over turning 5% into 7% or 7% into 9%, while voluntarily spending in ways that require 12% just to stand still. A man who insists on an $80,000 lifestyle with a $1 million nest egg and a 4% withdrawal rate is asking his capital to double 2 or 3 more times while he sits on the couch. A man who can live adequately on $40,000 with the same million is asking something very different. In the first case, even 3 or 4 doubles on paper may not keep up with inflation withdrawals. In the second, one double over 20 years plus continued partial work may be sufficient. So if the old simple rule is broken for you, what replaces it? Not a new magic number. A new set of questions and a new way to think about what compounding is actually doing for you after 50. You stop fantasizing about neat sequences of doubles. You start thinking in terms of how much time do I realistically have? What return assumptions are conservative enough that if I'm wrong, I'm not ruined? What level of volatility can I stand without folding? How much can I safely withdraw without cutting the tree down to get the fruit? None of those fit on a coffee mug. But they're the questions that matter if you don't want your last 20 or 30 years to be an extended exercise in financial anxiety. The next step is to walk through what compounding really looks like in numbers for a 50-year-old, a 60-year-old, a 70-year-old under realistic conditions, not brochure conditions. When you see that, you'll understand exactly why Munger put so much emphasis on avoiding stupidity instead of daydreaming about high returns, and why after 50, the rule of 72 belongs in the trash can unless you know exactly how it can lie to you. So let's do the arithmetic the brochures leave out. Start with a 50-year-old, not a trust fund kid, not a genius, just a normal person who finally woke up after 2 or 3 decades of wasting time. Say he's got $200,000 invested, no debt that's eating him alive, and he can now save $15,000 a year. He's hoping to stop full-time work somewhere around 67. That's 17 years. If he earns a conservative 6% nominal return before inflation and costs, and let's be kind and say 4% real after both, what does compounding actually do for him? Run it straight. His existing $200,000 at 4% real for 17 years grows to about $386,000. Not nothing, but not a miracle. His stream of $15,000 yearly contributions is where the real power hides. At 4% real, over 17 years, that series builds to around another $360,000. Add them, and you're somewhere in the neighborhood of $740,000, give or take. That's the realistic path, not fantasy. No 10% doubles every 7 years. No day trading miracle. Just a man in his 50s refusing to keep being stupid. Now notice what the rule of 72 would have whispered in his ear. At 7% nominal, you'll double in 10 years. At 8%, 9 years. Fill your head with that, and you might idly imagine $200,000 becoming $400,000 by 60, then $800,000 by 70, without you lifting another finger. The reality was that he needed those $15,000 contributions every single year to even approach $750,000 by his late 60s. Pretend the returns alone will do the job, and you get half the result at best. Take another 50-year-old a bit better off. She has $400,000 saved, can add $20,000 a year. Same 17-year window to 67, same 4% real. At 67, her starting $400,000 would be roughly $772,000. Her contributions add another $480,000 or so. She's around $1.2 million in today's money. That starts to look like genuine capital. But again, notice where it really came from. The original $400,000 roughly doubled over 17 years. The rest, about $480,000, is fresh savings and their own modest compounding. The doubles alone didn't deliver the outcome, work did. Now move the starting line to 60. A 60-year-old with $400,000 in 10 years until 70, saving $20,000 a year, same 4% real. His $400,000 grows to about $593,000. His 10 years of $20,000 contributions grow to roughly $243,000. That's around $836,000 at 70 in today's purchasing power. Not trivial, not sail around the world money, and miles away from the mental picture of I'll double a few times and end up with 2 or 3 million. At 60, the window for clean doubles is almost closed. You get maybe one slow, partial double in real terms if everything goes decently. That's it. The math is not cruel. It's honest. Now, for the 60-year-old who woke up late with $100,000 instead of $400,000, saving $10,000 a year for that same decade at 4% real, his $100,000 becomes about $148,000. His contributions grow to roughly $122,000. He lands around $270,000 in today's money by 70. That's reality. Not hopeless, but not what the rule of 72 daydream tells him. You can stare at 72 divided by 7 equals 10 years to double all day. It won't change the fact that starting with a small base late in life and saving modestly leads to a small but useful pile, not a fantasy fortune. For the 70-year-old, the conversation shifts completely. Suppose she has $500,000 and expects maybe 15 more years on the planet. At 4% real, left untouched, $500,000 becomes about $900,000 in purchasing power terms by 85. Nice if you don't need to eat in the meantime, but if she needs to withdraw, say $20,000 a year, inflation adjusted, that $500,000 is not doubling in any meaningful sense. It's funding her life. Compounding at that stage is not about watching the line go up. It's about how slowly you can let the line go down without cutting yourself off at 82. This is what the cheerfully repeated rule of 72 refuses to show you. Compounding is always fighting 2 silent enemies: time left and money flowing out. For a 30-year-old who keeps shoveling in new capital and doesn't touch it, the rule is a cute mental shortcut. For a 60-year-old about to start drawing down, it's a distorted mirror that makes you think the reflection is younger and richer than it is. Now layer on the path issue. The sequence of returns. Imagine two 60-year-olds, each with $800,000 and the same plan. Retire at 65, withdraw 3.5% of their starting balance in year one, that's $28,000, increasing that withdrawal with inflation each year. Both earn the same average return of 6% nominal over the next 25 years. But for one, the first 5 years are ugly. Down 25%, then flat, then up 5%, then down 15%, then up 5%. For the other, those bad years come at the end of life instead of the beginning. On paper, both live through a 6% environment. In reality, the one who took big hits early while withdrawing will watch his balance deteriorate far faster. By the time markets average out, he's pulling a larger dollar amount from a smaller base. The later bad years, which the brochure treats as a rounding error in the average, land like a hammer on what's left. The unlucky one might see his portfolio sag toward the danger zone in his late 70s. The lucky one, who breezed through strong early years and only hit storms in his 80s, may still die with a cushion. The rule of 72 doesn't care where those 25% end, 15% hits land. Your life does. That's why Munger spent his life preaching margin of safety. The future will not hand you a neat series of 7% gains. It will hand you stretches of feast and stretches of famine. And if your entire plan is built on the assumption that famine never comes in your 60s, you don't have a plan. You have a fantasy. Now inject behavior. Imagine that unlucky 60-year-old again. Portfolio at $800,000, bad years hitting early. At 62, he sees his nest egg down 25% from $800,000 to $600,000. All the tidy, doubling stories in his head vanish. Fear, not math, takes over. He sells to stop the bleeding. He moves to cash or safe products. He locks in the damage. Then, as happens routinely, the market recovers over the next several years. The index chugs along to that same 6% average described in historical data. Our man does not. He misses much of the rebound sitting in low-yield products, re-enters too late, and spends the rest of his life complaining that the market betrayed him. The market did exactly what it always does. It punished impatience and overconfidence. This is why a simple little back-of-the-envelope rule is broken for you after 50. It's not sophisticated enough to encode your behavior, your timing, your withdrawals, or your actual starting point. It acts like an immortal, unemotional, fee-free, tax-free robot is in charge. You are not a robot. You are an aging primate with fears, obligations, and an ego. The pretense that you can just plug in 8% and count the doublings is an evasion of responsibility. So what does a sane Munger-style investor do with all this in midlife or later? He flips the question. He stops asking, how fast can I double? And starts asking, how slow can I avoid being cut in half? He stops anchoring his expectations to historical averages and starts anchoring them to worst-case survivability. He doesn't say, if I get 8%, I'll be fine. He says, if I only get 4% real and the first decade is rough, will I still be breathing financially? For a 50-year-old, that might mean accepting that the next 20 years will likely only give you one solid double in real terms if you're lucky, and building your plan around that, not three imaginary doubles. If $300,000 today becomes maybe $600,000 in purchasing power by 65 at reasonable risk, then the question becomes, what savings rate and what working horizon do I need so that $600,000 plus my other income sources actually supports my likely spending? Not, how do I turn $300,000 into $2 million because some rule suggested I could if I squint hard enough. For a 60-year-old, it means giving up the entire pretense that you can rely on returns alone to do any serious lifting. At that age, the next 10 to 15 years of compounding will make your life more or less comfortable at the margin. They will not pull you from poverty into luxury. The big levers left are how long you work, how much you spend, and whether you avoid catastrophic mistakes. Compounding becomes a supporting actor. You stop treating it as a superhero. For a 70-year-old, it means dropping the language of investing for growth and talking about owning assets that can support withdrawals without disintegrating. There is no realistic doubling schedule for a 70-year-old drawing down. There is only the question, what mix of assets and what withdrawal rate makes it least likely that I run out of money before I run out of breath? The rule of 72 has nothing to say about that. Another subtle way the rule misleads older investors is by ignoring inflation's theft in plain sight. The rule tells you how long to double nominal dollars. It says nothing about what those dollars buy. At 3% inflation, prices double roughly every 24 years. That means a $1 million portfolio that doubles nominal terms over 24 years to $2 million has, in real terms, stood still. Your apparent doubles are running just to keep pace with your cost of living. At 4% inflation, doubling time is closer to 18 years. If your money doubles every 18 years in nominal terms, and so do your expenses, you are not compounding. You're treading water. You cannot afford that illusion in the back half of life. A 50-year-old pretending he'll double his money every decade ignores the possibility that he'll also double his costs every 2 decades at moderate inflation. Plenty of people hit 65 bragging that their net worth is twice what it was at 45, then discover that life is also twice as expensive, and their real wealth is flat or worse. The rule of 72 cheerfully encouraged that misunderstanding. It never promised to adjust for reality. Munger's way around all of this is crude and effective.
Stop using rules that let you avoid thinking. Do the real math for your situation. Write it down. How old are you? How much do you have? At what realistic, net of everything rate could that grow? Over how many years until you'd like the option to stop working full-time? What do you actually spend in today's dollars? And what multiple of that does your capital represent? Will that multiple still be adequate if real returns are lower than you hope, or if you live longer than you expect? When you answer those questions honestly, you discover two things. First, the doubling fantasies were flattering you. Second, you are not powerless. You have levers you can pull that matter more than squeezing another percent out of your portfolio. You can increase your savings rate in your 50S and 60S when your income is often at its peak. You can delay retirement, shrinking the number of years your capital must support and giving compounding more time to work. You can lower your baseline spending so that your future withdrawal rate is 3% instead of 5%. Each of those moves does more for your odds than any trick involving 72. You also have levers you must refuse to touch. More leverage, more complexity, more fees, more cleverness. A 55-year-old chasing 15% annual returns to make up for lost time is not applying the rule of 72. He's putting a gun to his head to see if it's loaded. If he survives the first spin, he'll call himself a genius. If he doesn't, it won't matter what math trick he memorized in a book. At this point, the question you should be asking is not, how do I fix the rule of 72? It's, what rules replace it for someone my age? What mental models keep me honest about compounding, risk, and time after 50? How do I define success in investing when the game is no longer be as rich as possible, but avoid a ruin I can't recover from? Those are the questions Munger actually cared about in his later decades. The answers aren't comfortable. They will not make for cute dinner party lines. They will make for a better last 15 or 20 years than the ones most people assign themselves by clinging to simplified nonsense. The next step is to strip those replacement rules down into something you can actually carry around in your head. A set of Munger-style principles for investing after 50 that treat compounding as a dangerous ally, not a guaranteed savior. That's where your real rule lies now. Not in a number you divide by 72, but in constraints you refuse to violate when it actually counts.
So what are those constraints? Not the pretty ones you see in financial ads. The real ones Munger lived by. Think of them as the rules of engagement for investing after 50 in a hostile world. Break them, and it doesn't matter how many compounding charts you've memorized. The game ends the same way. You age into weakness with less money than you thought, and less time than you need. First rule, compounding after 50 is a survival tool, not a lottery ticket. Your goal is not to maximize return. Your goal is to minimize the chance of ruin. That sounds boring until you remember what ruin actually means at your age. Not being able to pay medical bills, not being able to say no to a bad job, living in a place you hate because you can't afford to leave, becoming a project for your children instead of an example. You don't need 15% returns to avoid that. You need 6% real that you actually capture year after year without blowing up. That is a very different problem from the one the rule of 72 pretends to solve. Second rule, adopt conservative return assumptions and then behave as if you might get less. Stop penciling in 10% stock returns and 4% safe withdrawals like you live in a textbook. From 50 onward, base your planning on maybe 7% nominal returns before inflation and 4% real after everything. Then test your plan at the low end of that band. Ask, if I only get 3% real, do I still make it without being humiliated? If the answer is no, the fix is not to raise the assumed return. The fix is to save more, spend less, work longer, or accept that your future standard of living will be lower. Arithmetic doesn't negotiate. Third rule, your savings rate and spending decisions are now more powerful than your investment choices. From 25 to 45, getting an extra 2% of return can be a big deal over 40 years. From 50 to 65, it's overshadowed by whether you choose to live on 60% of your income or 95%. A 55-year-old earning $150,000 who saves $30,000 a year and earns 5% real for 15 years builds roughly $750,000 of new capital, plus the growth of what he already had. A man with the same income who saves $5,000 a year and chases 9% returns builds far less and likely takes risks that blow up his base. Munger's way is brutal. Fix the part of the equation under your direct control. The gap between income and outgo. Before you go hunting for extra return points that may or may not exist. Fourth rule, defect from the cult of fixed retirement age. After 50, your working years are not a prison sentence to be served until a calendar date. They are a tool that buys you compounding time and shrinks the number of years your portfolio must support. Every extra year you work in your 60S does two things at once. Adds savings and removes 1 year from the retirement burden. That's a double effect the rule of 72 never mentions. Retiring at 62 with $800,000 is not the same as retiring at 68 with $1,100,000 and 6 fewer years to fund. The second man is given compounding more runway and reduced the years over which sequence risk can kill him. Most people treat working longer as pure loss. Munger would call it cheap insurance. Fifth rule, build in a margin of safety at 3 levels. Allocation, withdrawals, and lifestyle. Allocation, don't hold more risk than you can stomach in a 40% drawdown.
If you know you'll panic out of a 100% stock portfolio in a crash, you have no business holding one. A 60-40th or 70-30th split that you can actually keep through hell is superior to an optimal allocation you abandon at the first sign of smoke. Withdrawals, aim for 3.5% instead of 4. 5%, especially if you're retiring into high valuations or low starting yields. Lifestyle. Live as if your portfolio is smaller than it is. If $1 million suggests you can safely spend $60,000, cap your life at $50,000 and let the extra margin accumulate as shock absorber. That gap is your survival buffer against bad sequences, bad policy, and your own future mistakes.
Sixth rule, outlaw leverage for your core capital. Munger was clear. There are 3 ways a smart man can go broke. Liquor, ladies, and leverage. You're not 25 trading meme stocks. You are past 50 trying not to wreck whatever base you have. Margin loans, securities-backed lines of credit, low-interest borrowing to invest more. These are ways to turn a normal bear market into a fatal event for someone your age. A 50% drop in an unleveraged equity portfolio is brutal but survivable if you have other income and decades ahead. The same drop on 2-1 leverage can wipe you out. At 58, that might be the last wipeout you ever get. The rule of 72 whispers debt can help you double faster. Munger's rule says debt will help you disappear faster. Seventh rule, compress complexity down to what you can actually understand and monitor. At 30, you can dabble in exotic products and learn expensive lessons. At 60, there is no tuition budget left. You own what you truly understand, or you own very broad, low-cost funds that don't require you to be clever. You don't need to know everything. You need to know when you're outside your circle of competence and act accordingly. Buying opaque structures or fashionable strategies because they promise enhanced yield or downside protection is how older investors quietly donate their futures to Wall Street. If you can't explain in plain English how an investment makes money and under what conditions it fails, it doesn't belong in your retirement base. It belongs in the trash. Eighth rule, treat fees and taxes as enemies, not background noise. From 50 onward, you don't have enough compounding time left to casually give away 2% a year in friction. We already walked through how a 1% drag can cost you 6 figures over a couple decades. After 50, that 6 figures is not extra. It might be the difference between living alone or with roommates, between choosing care or having it chosen for you. That means you avoid high-fee funds and advisors, whose main skill is extracting basis points from your balance. It also means you minimize turnover in taxable accounts, so you're not paying capital gains every year for the privilege of rearranging chairs. Munger and Buffett let winners run for decades for many reasons. One was simple. Not paying tax until you have to is a free form of compounding. Ninth rule, design your portfolio so you never have to sell at the wrong time. The rule of 72 imagines you're never forced to touch principal. Reality says otherwise. You will have emergencies. You will have temptations. You will hit bear markets. If every dollar you own is in volatile assets, you will eventually be forced to sell some of them at an inopportune moment just to live. The way around that is boring. Keep a buffer of safe assets. Cash, short-term treasuries, high-quality bonds, equal to at least a few years of basic spending. That buffer is not there to maximize return. It's there to absorb shocks so your equities can actually do the long-term compounding the charts promised. 10th rule. After 50, your default attitude toward new investment ideas should be no. Not maybe. Not tell me more. No. The burden of proof is on the new thing to justify breaching your current plan, not on your plan to justify its existence against every shiny object. A stable, sensible allocation, plus a disciplined savings and withdrawal pattern, will get you most of what is still mathematically possible from where you are. Changing horses midstream because something feels exciting is how you give that away. Munger loved the idea of sit on your ass investing for a reason. He knew that activity is usually a tax on impatience, not a route to outperformance. Once you internalize those rules, you stop worshiping doubling formulas and start running real scenarios. Take your age, your assets, your savings ability, and test them under harsh assumptions. The 52-year-old with $300,000 who thinks in terms of doubling 3 times needs a different mental model. At 4% real, he might get one true doubling by his late 60s if he doesn't touch it and contributes along the way. So he designs his life around making that one doubling as likely as possible. High savings rate, extended work, low fees, no leverage, modest lifestyle, a 3% withdrawal strategy. In that world, $300,000 today plus contributions might realistically become $800,000, $1 million in today's money by 70. Not because he hit some magical return, but because he stopped fighting the math and started cooperating with it. The 60-year-old with $500,000 has even fewer moves. He's not going to double 3 times. At 4% real, he might see that become $700,000, $800,000 in purchasing power by his early 70s if he keeps working and adding. He can choose to be offended by that, or he can choose to align his spending and work plans with what is still possible. That might mean shifting from I'll never work again after 65 inches to I'll work part-time into my early 70s so my withdrawals can stay low, and my portfolio has time to recover from any rough patches. It's not fun. It is rational. And that's precisely the kind of trade Munger respected. Giving up ego to gain survival odds. The rule of 72 flatters you by pretending your money doubles itself while you stand still. Munger's rules insult you into admitting that what you do in your 50s, 60s, and 70s matters more than any neat little fraction. You can lower your required lifestyle. You can extend your working years. You can stop paying people to mismanage your money. You can avoid leverage and nonsense. You can select a withdrawal rate that isn't suicidal. You can structure your portfolio so that when, not if, the market falls, you don't blow up emotionally and financially. In that sense, the rule of 72 inches that actually matters after 50 is a rule of survival. 72 months, 6 years. Ask yourself, if the next 6 years are bad for markets, bad for inflation, and bad for my health, have I built in enough margin of safety that I'm not forced into ruinous decisions? If the answer is no, you fix that before you dream about how many times you'll double before 90. Because if you can't survive the next rough 6 years, the hypothetical doubles 20 years from now are irrelevant. You don't need catchy shortcuts. You need to stop outsourcing your thinking to them. Munger's entire career was one long demonstration that simple, brutally honest reasoning beats elegant lies every time. After 50, that kind of reasoning is not optional. It's the only thing standing between you and the fate most people drift into. Old, surprised, and broke, still clinging to rules that were never written for bodies on a clock and portfolios under stress. The rule of 72 is not your enemy. Your misuse of it is. Throw out the fantasy version. Keep the underlying respect for compounding. Then do the one thing the slogan never demanded of you. Behave like someone who understands that time, risk, and stupidity are more powerful than any neat little division problem. The market will not care either way. But your future self will know exactly which choice you made.